Hello, and welcome to Facts Matter. I'm your host, and in this episode, we're going to talk about the economy, specifically why the data is telling a very different story than what you're hearing in the news. The economy grew 4.4% last quarter. Unemployment is at 4.2%. The stock market is near all-time highs. So why did 1.2 million Americans get layoff notices in 2025, the most since the pandemic? I went into the official government data from the Bureau of Labor Statistics, the Federal Reserve, the Conference Board. And what I found tells a very different story than what you're hearing on the news. Let me show you. Here's what the headlines tell you. GDP grew 4.4% in Q3 2025. That's according to the Bureau of Economic Analysis. The Atlanta Fed is now tracking Q4 at 5.4%. By that measure, this is one of the strongest economies in years. But here's what they're not telling you. According to Challenger, Gray, and Christmas, the firm that tracks corporate layoffs, U.S. employers announced 1.21 million job cuts in 2025. That's up 58% from 2024. It's the highest total since 2020, when the pandemic shut down the economy. At the same time, employers announced about 500,000 hiring plans in 2025, the lowest since 2010. And the Bureau of Labor Statistics shows that only 584,000 jobs were added in all of 2025. That's an average of 49,000 per month, the weakest job growth since 2003, outside of recessions. So GDP is surging, but hiring has essentially stopped, and layoffs are at pandemic levels. Economists call this a jobless boom, growth that doesn't translate to jobs, and historically, it doesn't last. Let me walk you through 5 data points, all from official sources that show what's really happening beneath the surface. We're going to go under the hood. The Conference Board, which has been tracking consumer sentiment since 1967, just reported that their consumer confidence index fell to 84.5 in January. That's a drop of nearly 10 points in 1 month, the sixth straight monthly decline. It's the lowest reading since May 2024. May 2014. And it's in the downtrend because you have 6 straight monthly declines. 11 years ago, that is from 2014, it's actually lower than the pandemic. But here's the number that really matters. The The expectations index fell to 65.1. According to the conference board, when this number drops below 80, it has historically signaled a recession ahead. We're at 65 right now. I mentioned the 1.21 million layoffs. Let me break that down. According to Challenger, Gray, and Christmas, government led all sectors with 308,000 cuts, up 703% from 2024. Most of this was federal workforce reductions tied to Doge. Technology came in second with 154,000 cuts, up 15% from last year. Warehousing announced 95,000 cuts, up 317%. Retail announced 93,000 cuts, up 123%. Meanwhile, employers announced about 500,000 hiring plans for the entire year. That's the lowest since 2010, when we were still climbing out of a great recession. Picture doesn't look good, folks. The Institute for Supply Management publishes the Manufacturing PMI every month. It's a survey of 400 purchasing managers at manufacturing companies across the country. Any reading above 50 means manufacturing is expanding. Below 50 means it's contracting. The December reading came in at 47.9. That's the 10th straight month of contraction. Let me say that again. The 10th straight month of contraction. That's the trend, and the trend is down. Manufacturing is already in recession. It just hasn't spread to the rest of the economy yet. New orders are weak, 47.7. Employment is falling at 44.9, and the price index is elevated at 58.5, meaning costs are still rising even as activity falls. That combination, falling activity with rising prices, is what economists call stagflation. Here's what you won't hear on CNBC. The Case Freight Index tracks the volume of shipments moving by truck and rail across North America. It's one of the best real-time measures of actual economic activity because if goods aren't moving, demand is falling. In December, shipments were down 7.5% year over year, hitting a new cycle low. For the full year, the index declined 6.1%, the third straight year of declines. When freight volumes fall, it means businesses are ordering less and consumers are buying less. It's a leading indicator that typically shows up before the official GDP numbers turn negative. The Federal Reserve Bank of New York tracks household debt and delinquencies. Here's what the latest data shows. Auto loan delinquencies, 90 days or more past due, hit 5%. That's a 15-year high. For subprime borrowers, it's even worse, 6.5%, the highest since they started tracking in 1994. Credit card delinquencies are at 2.83%, and credit card balances just hit 1.08 trillion credit card balances. People need their cars to get to work. When they're missing car payments, they're in real financial trouble. This is household stress showing up in the data. Now let me show you the indicator that has predicted every recession since 1960. It's called the yield curve. Specifically, the difference between the 10-year treasury rate and the 2-year treasury rate. Normally, long-term rates are higher than short-term rates. But when investors expect trouble ahead, they pile into long-term bonds for safety, and the curve inverts, meaning short-term rates are actually higher than long-term rates. An inverted yield curve has preceded every U.S. recession since 1960. From October 2022 to December 2024, we had the longest yield curve inversion in recorded history, over 2 years. Now, here's the part most people miss. The recession doesn't happen during the inversion. It happens after the curve normalizes, typically 6 to 18 months later. The curve uninverted in late 2024. That puts the recession window at June 2025 through June 2026. Let me repeat that. The curve uninverted in late 2024 that puts the recession window at June 2025 through June 2026. We're in that window right now. So what do you do with this information? I'm not here to tell you to panic. Um, I'm here to tell you to prepare. That's why I wanted to present the data to you. First, build your cash reserves. Don't assume your job is safe. 1.2 million people got that news this year. Have 3 to 6 months of expenses set aside if you can, or should I say last year. Second, if you're job hunting, start early. Hiring plans are the lowest they've been since 2020. Network now, not when you need it. Third, pay down high interest debt if you can. Credit card rates are still elevated, and if the economy does turn, you don't want to be stretched thin. Fourth, watch the data, not the headlines. Let me repeat that. Watch the data, not the headlines. The indicators I just showed you move 6 to 12 months before the official recession call. By the time CNBC says we're in a recession, it'll be old news. I track this data every week. If you want to see what's actually happening in the economy before the headlines catch up, um, subscribe and hit the bell. You don't have to subscribe or hit no bell. I don't even have anything on the channel for you to subscribe. It's not about subscriptions and people hitting the bell and likes and all that. I created this channel because I want to get the real information out to people. That's why I called it Facts Matter. I want the public to have the real data, not what's being said on your main media news stations, because they have an agenda. I don't have an agenda for you. That's why I don't care if you like this or if you give me a thumbs up or if you don't. I don't have your subscription, and I probably won't. I just want to get the data out there to you. You decide what you want to do with this data, with this information.